Vietnam's economic transformation over the last few decades has been nothing short of extraordinary. Not long ago, the country was impoverished and devastated by war. But starting in the 1980s, a series of bold market reforms helped steer Vietnam onto a new path, turning it into one of the world's rising manufacturing hubs. Since then, Vietnam's GDP per capita has increased nearly eightfold, and rapid industrialization has lifted tens of millions of people out of poverty. With a youthful population of around 100 million, it's now one of the fastest-growing economies in Southeast Asia. But this success story comes with a major catch. Vietnam's economy is now deeply tied to two of the world's most powerful and often competing nations: the United States, the world's biggest consumer market, and China, the world's factory. As tensions between these two giants continue to rise, Vietnam finds itself caught in the middle of a delicate balancing act. To better understand this dilemma, let me show you two charts. The first chart shows Vietnam's exports by destination from 2017 to 2023. In 2017 and 2018, exports were fairly balanced among the top three markets: the U.S., Japan, and China, each receiving about $40 billion worth of goods. But after that, exports to the U.S. surged. From 2018 onward, Vietnam's exports to America grew at an average annual rate of 15%, far outpacing exports to other countries. By comparison, exports to China grew at about 8% per year. Vietnam's exports to America now accounts for around one-third of its total exports. Now, take a look at the second chart. This one shows Vietnam's imports by source country over the same time period. Here, China dominates the picture. Since 2017, Vietnam's imports from China have consistently led the pack, and with time, that lead has only grown. Imports from China expanded by about 11% annually, more than double the pace of imports from neighboring ASEAN countries, which grew at 5%. So what do these charts tell us? In short, Vietnam is extremely dependent on trade. It relies on the United States to buy its goods, and on China to supply the raw materials, machinery, and parts that its factories need to make those goods. It's a delicate triangle, one that has worked well so far, but is full of risks. So how did Vietnam end up in this position? The roots go back to the very reforms that gave Vietnam its current success. Vietnam had a small, underdeveloped economy, so focusing on export-led growth made a lot of sense. The strategy was simple: attract foreign investment to set up factories, tap into global supply chains, and profit from export markets. Naturally, Vietnam focused its exports on nearby giants: China, Japan, and ASEAN, along with the massive U.S. market. Then came a major shift in 2018, the U.S.-China trade war. The U.S. imposed tariffs on China in an attempt to reduce reliance on Chinese manufacturing. But instead of bringing production back to America, where costs are high, many companies started looking for cheaper alternatives. This gave rise to what's known as the China Plus One strategy. In this model, businesses keep some operations in China but move parts of their supply chain to other low-cost countries. Vietnam, with its cheap labor, geographic proximity to China, and improving infrastructure, became a top destination. Companies could import materials cheaply from China, do the final assembly in Vietnam, and export finished products to the U.S. at much lower tariff rates. In other words, Vietnam plugged itself directly into China's supply chain. This strategy supercharged Vietnam's growth, but came with strings attached. Because Vietnam is now so dependent on both China and the United States, any tension between those two powers puts Vietnam in a tricky spot. And that is exactly what has happened. Washington is growing increasingly concerned that some Chinese goods are bypassing tariffs by being rerouted through Vietnam. That has led to pressure on Hanoi to crack down on so-called transshipment. Meanwhile, Beijing has issued warnings of its own, urging Vietnam not to support U.S. economic moves that might hurt China's interests. And this is where the real dilemma lies. Vietnam's trade surplus with the U.S., which hit over $120 billion in 2024, is vital. It brings in foreign currency, supports jobs, and fuels domestic growth. But at the same time, Vietnam imports over $140 billion in essential goods from China, including the industrial inputs its factories simply can't operate without. Now you might be wondering, why doesn't Vietnam just build its own supply chain and reduce its dependence on China? Well, that's a lot easier said than done. China didn't become the world's factory just because of low wages. It's also about scale. China has the land, labor, logistics, and capital to support an entire end-to-end manufacturing ecosystem. Vietnam, as a much smaller country, simply doesn't have the same capacity. It would take decades and enormous investment for Vietnam to replicate even a fraction of China's supply chain capabilities. So even if Vietnam wanted to decouple from China, it wouldn't be easy. It may not even be possible. So Vietnam's challenge is to maintain its neutrality while benefiting from both sides, leveraging U.S. demand for its exports, while maintaining access to Chinese inputs that keep its factories running. It's a tightrope walk, and one that's getting harder as global geopolitics heats up. But what do you think will happen if Vietnam is forced to pick sides? Leave your thoughts in the comments below.